Imagine having the ability to anticipate the market movements before they happen, to turn volatility into opportunity and uncertainty into your advantage. Today I'm going to share you 3 books and one legendary trade that helped me build the very strategies I teach. And I believe they will elevate your trading. If you are serious about mastering volatility, you are in the right place. Let's dive in. Book number 1, Retail Options Trading by Schindler and Mack. This book is a goldmine for understanding the behavior of volatility. It changed how I see volatility, not as a threat but as an edge. Yuan breaks down how to turn option pricing into opportunity. The mindset shift it gave me, priceless. If you want to master volatility like a professional, this book is your playbook. Book number 2, Trading Volatility by Colin Bennett. This book goes deep into volatility cycles, how options react to macro events, and most importantly, how to adapt when volatility changes. Many strategies I teach, like VRP, forward volatility, calendar spread, are rooted in this book. Bonus: the soft copy is free on Colin's website. Resource number 3, Jim Campesino's research paper. We have already covered this in our earlier video, but it deserves a mention again. Jim Campesino's paper on forward volatility is absolute gold for understanding how to exploit the short-term overpricing in the option. If you haven't read it, revisit the link in our forward volatility video. Alright, the books are great, but now let's bring this theory into practice. We are going to break down a legendary volatility trade by Schindler himself, former trader at Bluefin and a PhD holder. This one trade will change the way you think about option trading forever. Let's go. Picture this. You are MS Dhoni, walking out in a final over of a T20 match. Do you swing blindly? No. You read the field, analyze the bowler, time your shot perfectly. That's exactly what pro traders like Yuan do. They wait, analyze, and then strike. And that's what he did with Apple Inc. in 2007. In 2007, Apple was the darling stock. The iPhone was launching. The stock had rallied 1000% in past 5 years. Hype was all-time high. Traders were flooding the market. Calls for the rally. Puts fearing a flop. Result? Implied volatility shot up. But Yuan saw what most didn't. He compared the forecasted realized volatility, which is 29%, with the implied volatility, which is 41%. That's a 12% gap, a goldmine for volatility traders. While others focused on direction, Yuan focused on mispricing. Here is what he did. He short implied volatility. He didn't care if the Apple launch was successful or not. His bet Apple wouldn't move as much as traders fear. That's the beauty of volatility trading. You are not betting on price direction. You are betting on how much the price will move. On June 26, Yuan entered the trade. His initial P&L was $4,953. Most traders would panic, but he stayed patient. On June 28th and 29th, Apple rallies slightly. Yuan hedges with 400 shares, still focused on the edge. On July 2nd, the stock barely moves. The P&L rises to positive 7,500. On July 3rd, the implied volatility softens. Yuan closes the position and his final profit is massive $18,390. Here are the key lessons from this trade. Ignore the hype. Don't trade the news. Trade the mispricing. Know your edge. Yuan's was IV was greater than RV. Trade smart, not hard. He exited early, didn't wait for the expiry. How to use these trades to your profit? Follow these 5 steps. Number 1. Spot setup where IV is greater than forecasted RV. Number 2. Validate the reason behind the hype. Number 3. Enter with proper hedging. Number 4. Exit once your edge plays out. And number 5. Keep reviewing your risk. Now let's test your understanding. Question number 1. What sets a professional trader apart from an average trader? A. More money. B. Better risk management and planning. C. More complex strategies. Or D. Better luck. The answer is B. Better risk management and planning. Question number 2. What was Yuan's core strategy in this particular trade? A. Betting Apple would go up. B. Betting Apple would crash. C. Shorting Apple's implied volatility. Or D. Buying long-term puts. The answer is C. Shorting Apple's implied volatility. Question number 3. What major event drove Apple's volatility in 2007? A. iPhone launch. B. CEO resignation. C. Earnings report. D. Dividend announcement. The answer is A. iPhone launch. Question number 4. What does Yuan observe before placing the trade? A. RV is greater than IV. B. IV was much higher than RV. C. Stock had low volume. D. Option prices were flat. The answer is B. IV was much higher than RV. Question number 5. What did Yuan do once the implied volatility dropped? A. Held until expiry. B. Closed the trade with an 18,390 profit. C. Add more puts. D. Roll the position. The answer is B. Close the trade with an $18,390 profit. Alright, drop your quiz score in the comments. I'll personally respond with the feedback and next step. If you found this valuable, share it with your fellow trader who is trying to understand volatility the hard way. Books and strategies like these are the game changers, but only if you apply them. Until next time, keep learning, keep winning.